This is Horizons Middle East and Africa, our top stories this morning. A widening war. The Houthis attacked two Saudi tankers in the Red Sea as the U.S. conducts further strikes on Iran. Oil rising as the market reckons with the possibility of a second front in the Middle East. And the nuclear path. The U.S. signs an agreement with Saudi Arabia to share nuclear technology, opening the door for the country to enrich its own reactor fuel. And burning the cash. Alphabet shares fall after another boost to its spending forecast. Meanwhile, Elon Musk warns of a massive capex year at Tesla as the AI race heats up. I'm Oliver Crook, live today in Brussels. It is 8 a.m. across the Emirates. It is 6 a.m. here in Brussels. Let's take it straight to the markets this morning with a full focus on, obviously, the fossil fuel trade. Brent this morning up above $96 a barrel. You can see there on the screen up about $2 a barrel, up 2.2% this morning. We're watching the euro very closely this morning because we have that all-important decision from the European Central Bank in Frankfurt a little bit later today. You can see the euro gaining a little bit there against the dollar, up 0.15% in full focus. We're not expecting a rate hike from the ECB after that hike last meeting, but the future path very much in focus in terms of what we'll see in inflation across the European continent. Of course, MSCI Asia Pacific Index up about 1% this morning. The chips and semiconductors gaining after we saw that big capex spend from the United States. And of course, you see the other side of that trade, NASDAQ futures there on your screen, down by about 1/3%. Let's keep it on the markets. Let's take it to Hong Kong with Winnie Su, who's got an update for us this morning. Good morning, Winnie.
Yeah, good morning, Ollie. Well, we are seeing a pretty positive session in Asia today with the MSCI Asia rising for a third session. As you just mentioned, technology shares really leading gains today after Alphabet say that they are raising their spending expectation to top $200 billion for this year. Now, that is really fueling the expectation for that money to trickle down to the supply chain in Asia. That's why you are seeing South Korea's Kospi index here up more than 3%. With foreign investors continue to buy, and that foreign inflow is also driving the won higher as you flip the board and see how the Korean won today leading gains among Asia peers. We are seeing a strengthening by 0.7% against the US dollar. Now, when it comes to Japanese yen, still hovering above that 163 level against the dollar, still around those weakest level in 4 decades. Now, yesterday we have heard that the Bank of Japan is open to raising rates faster than consensus, and that kind of bet, the hawkish bet for the Bank of Japan to raise rates is also driving the 2-year yield here higher, and that is why we are seeing the yield curve also steepening, while the 10-year yield still also slightly higher, tracking those moves from the treasuries overnight. Back to you, Ollie.
Thanks very much, Winnie Su, over there in Hong Kong, keeping us abreast of all the market action over in Asia. I want to keep you abreast of some of the earnings stories out of the Emirates this morning. Emirates NBD, the second quarter operating income coming in at 13.5 billion dirhams. That is very close to the estimate of 13.31 billion dirhams. The net income figure for the second quarter there for Emirates NBD at 6.4 billion dirhams, and a net impairment there. Maybe we'll keep an eye on that of about 600 million dirhams in the second quarter, bringing it to the First Abu Dhabi Bank as well, FAB, second quarter operating income at 10.17 billion dirhams for the second quarter. That is a beat, a very modest beat there of the estimate of 9.7 billion. And of course, we're watching, of course, profit there at 5.7 billion, beating the estimate of 4.48. So we'll keep you abreast of those stories as they develop through the morning as the trade gets started over in the Emirates. But from the sort of earnings story to the geopolitics, which are front and center this morning, Yemen's Houthis say they have attacked 2 oil tankers in the Red Sea, threatening to open another front in the Iran war. Minutes before the Houthi statement, the UK Maritime Trade Operations Center signaled a report that a ship had been struck southwest of the Al Shuqaiq on the Saudi Red Sea coast. Saudi Arabia did not immediately comment on the attack. Meanwhile, as the U.S. completed a 12th straight night of attacks on Iran, President Trump out on social media posting that anytime the Islamic Republic of Iran shoots at a ship in the Strait of Hormuz, the United States will bomb and destroy one bridge or power plant, including those located next to or in the capital city of Tehran. Let's get more on this story with Oner Anand. He's Bloomberg's managing editor for the Middle East, North Africa, and joins us now from Dubai. So listen, now we're trying to reckon with, we've had a sort of some idea of how to price the Strait of Hormuz, the sort of disruptions from there. There is now a conversation within the markets of how to price a possible second front in the Red Sea. Are the markets able to do that? What is the reach of the Houthis at this stage?
Well, the overnight attack on shipping by Houthis marks the first time they struck an oil tanker after they announced that they would be imposing a blockade on any ship calling for Saudi ports in the Red Sea, Oliver. And as you said, that's critical information because after the war on Iran began and after the effective closure of Hormuz, the Red Sea coast is where the Saudis redirected a bulk of their oil exports, and they became so reliant on the area that loadings at Yanbu alone exceeded 4 million barrels a day in June, and that was the highest on record. So any successful attempt by the Houthis to prevent that export route being used by the Saudis will have a huge impact, not only on Saudi oil exports alone, but for the oil market in general, as it would risk removing a key part of Saudi crudes reaching the markets. And important to note, as you already mentioned, is the fact that this attack came literally hours after President Trump made an explicit warning calling on Iran to stop attacks on shipping through Hormuz, which is the other key choke point for oil trades out of the region. He did say that every time a ship comes under attack in Hormuz, there will be a plant or a bridge in Iran that will be bombed by the U.S.
Well, Oner, at the very center of the war in Iran is this conversation about enriching uranium. And I want to take you to another story with the United States and Saudi Arabia, who have now finalized a nuclear technology sharing deal, which could see American companies building reactors in the kingdom, but also the kingdom enriching its own uranium. We also heard from the U.S. Secretary of State Marco Rubio a short moment ago. Have a listen to that.
Well, I'm not going to opine directly on that agreement. We're going to put out even when the moment is appropriate, we'll put out that in writing. We have to do it with Congress anyways, so we'll certainly do it publicly. But suffice it to say, the U.S. is not going to reach any agreement with any country in the world that leads to the risk of proliferation.
So, Oner, give us a bit of the details of this agreement and give us some of the context around this at a moment where enrichment of uranium and this nuclear material is such a focus in the region.
Well, this deal was long in the making, but the actual signing paved the way for criticism that you just pointed out. According to the Wall Street Journal earlier this week, this deal would allow American companies and Saudi companies to conduct a joint study into whether or not domestic enrichment of uranium in Saudi Arabia would be feasible or justified. Now, that is especially important given the fact that the primary justification for the recent war on Iran was basically the fact that it would prevent Iran from acquiring nuclear weapons. Now, what critics say, including U.S. senators, is that if the deal actually allows Saudi Arabia to enrich uranium on its soil, it could pave the way, or it could spur a race for domestic enrichment in the larger Middle East region and eventually an arms race. U.S. Secretary of Energy Chris Wright said that the deal includes highest standards for nuclear security and high standards for non-proliferation. But nonetheless, what critics argue is that allowing the kingdom to enrich uranium domestically would eventually spur a race for similar deals with the U.S. Down the road, Oliver.
Well, Oner Anand, thank you so much. Bloomberg's managing editor for the Middle East and North Africa for the important update on those two stories. I want to take us to another important update on the other story that is occupying markets this morning, and that is, of course, the AI race. Alphabet is doubling down on the AI race, lifting its spending outlook as it rushes to build out data centers, and the company reported stronger than expected cloud growth for the last quarter, but the higher price tag is likely to intensify scrutiny of its AI returns. Let's bring in Bloomberg senior market strategist Neil Campling. Listen, we've got the numbers out from Alphabet this morning. Obviously, the capex is the sort of attention grabber, now breaking above that $200 billion mark. How significant is that? What were your other takeaways from the numbers from Alphabet?
Yeah. Firstly, we look at the key in terms of those revenue growth drivers. As you mentioned, cloud growth was incredibly strong. Cloud grew 82% year on year from a very large base. It's an acceleration from the previous quarter. That was against expectations from the street of 65% and against even the most bullish buy-side experts of 75%. The problem is, as you mentioned, is that the race for AI means that the CapEx is exploding higher and shows no signs of slowing. They've already said that 200 billion is likely to be significantly higher still in 2027. The problem they have is this is like a cash machine, an ATM in terms of the business for the last 10 years or so, printing so much money in terms of cash. And for the first time, we've now got a free cash flow negative quarter. So that high growth is also coming with high expenses. And the big issue here going forward is what happens in terms of returns on invested capital. The race for the frontier AI model leadership, of which Alphabet is one of the key players, there's no guarantee in the future as to which companies will win out. So for the time being, that CapEx spend, especially having come above huge amounts of money raised in the debt markets, is a question investors will be weighing up to offset against the growth questions.
Yeah, Neil, and it's a question investors will also be weighing up over at Tesla. We heard from the CEO of Tesla, Elon Musk, speaking about their earnings. Obviously, this is a car company. It's kind of also not a car company. Have a listen to what Elon Musk had to say.
We should be spending on CapEx as fast as we can spend, as fast as we can, without it being too wasteful. So we're not trying to aim for like some extremely high efficiency capital spend, because that would slow things down. So it's a balance between like how much sort of capital efficiency versus time.
So Neil, the takeaway there, we need to spend money as fast as possible, and we don't need to do it in the most possible efficient way. What are investors to make of this? Is there still sort of the charm of the Elon Musk factor? What do you take away from that?
I mean, on simple terms, the auto business actually had a really good quarter. The problem is, in terms of if you look at earnings and margins, and as you mentioned, the cash spend, they raise more questions. And the money that they're spending is on things like the robots and the robotaxis and the autonomous vehicles, which really are very small in terms of the overall business. So in terms of the race to spend the money, but there's no discernible sign that there's going to be any kind of growth increase or any kind of returns on that CapEx spend. So fiscal discipline is not something that really comes across in terms of what Musk was saying last night. So it raises more questions than answers, I think, for Tesla in particular, when they are actually so far behind the AI race compared to companies like Alphabet.
Yeah, well, thank you very much for Bloomberg senior strategist Neil Campling there, keeping us across the AI story and, of course, the all-important CapEx story we're really seeing moving markets this morning. But still ahead, we're going to be talking about the fixed income market and unpack how the latest shocks caused by the Iran war is delaying a global easing cycle by keeping inflation elevated. This is a conversation we'll be hearing later again at the ECB. It's a conversation at the Fed, and it's certainly a conversation across the Middle East. We'll have much more on that next, and this is Bloomberg. Well, oil prices are climbing this morning after Iran-backed Houthi militants said they targeted 2 Saudi Arabian tankers in the Red Sea. The escalating Middle East conflict now threatening to cause further supply disruptions and, of course, opening up potentially a second front to that war. For some analysis on what it means for the broader markets, we're joined now by Amol Shitole. He is head of fixed income at Mashreq Capital. Amol, thank you so much for joining us this morning. I'd like to just get your very sort of top-line view here. We've had a sort of lesson over the last couple of months of how to price disruption over the Strait of Hormuz. What lessons do we need to learn about pricing disruption in the Red Sea?
Morning, Oliver. Good to hear. Clearly, I mean, the volatility in the regional bond market has picked up, especially since 9th of July. And we see that continuing through the summer. As you pointed out, oil prices are up $96 per barrel. That's about 55% higher than the pre-war levels. I think one thing to note here is that most of the Gulf economies have fiscal break-even oil prices anywhere between $40 to $90 per barrel. That makes them, fiscal surplus category, right? And I think the one economy which really, falls out of this bracket is Bahrain, which is a different story, which is likely to be a structural issuer of bonds. But barring that economy, I think most other economies benefit from higher oil prices in the interim.
And thinking about what the effect is going to be on the sort of various rates of the nations that you cover, how do you see that filtering through the region?
Clearly, I mean, Gulf economies have pegged currencies to US dollar. They don't have their own monetary policy. They rely on Fed policies to really mirror when they price in local rates. Having said that, some of the oil importing economies like Egypt, they really suffer because of higher oil prices. And the reason being they are one of the largest oil importers in the region. Their interest rates are at 19%. It tends to delay their easing cycle given inflationary pressures and FX pressures. So I think some of these economies are going to have a delayed easing cycle given the backdrop.
Well, thinking about the Fed, since you bring it up, what are you expecting as we look into next week? I mean, I thought that we were pretty confident that there would be basically no move at the Federal Reserve. I now look at the market pricing. We're seeing about a 35% chance potentially of a rate hike. Why do you think we're seeing that within the market? Is this a communication situation over at the Fed? What are your expectations for the Fed looking into the back half of the year?
It's a great question, Oliver. Yeah, I mean, we are expecting Fed to be on hold on 29th of July. If you remember at the beginning of the year, markets were pricing 2 rate cuts, and at some point during this quarter, we are looking at 1 rate hike. I think market is correct in anticipating a hold during this meeting, and the reason being we haven't really seen pass-through of oil price shock into core inflation yet. If anything, both headline and core inflations were softer in the US if you look at the last print. So I think until we have evidence to see that inflation is actually passing through into service sector of the economy, there's no reason for a Fed to actually raise rates at this point in time. And also, you got to consider the growth outlook for the US. I think we are rolling off from supportive growth to slower growth at some point later this year. So I think if you put it all together, I think hold makes more sense, and I think market is accurate in pricing that at this point in time.
And I want to talk to you about the broader conversation globally around inflation. So obviously we've had a focus on the Strait of Hormuz, and that has been principally a focus and a concern with energy prices. However, a disruption in the Red Sea, for example, will affect other shipping and other goods and other commodities. We're also seeing within Ukraine and Russia more targeting of ships there that is having a massive disruption within wheat prices. That's up about 20% since the beginning of July. How much of a threat do you think there is of a new inflationary surge to deal with all of these different bottlenecks we're seeing in global shipping?
Absolutely. It's a very relevant question at this point in time. And if you look at bond yields across the world, they're elevated and they're close to cycle highs. I think food and oil inflation really pass through headline numbers, and central banks around the world really track core inflation when they take rate decisions. So I think core inflation is still orderly, determined. I think if this situation extends with Iran, there's a real risk that some of it actually passes through core, and then there could be a reason for central banks to actually raise rates at some point later this year. But that's not our base case scenario. We still expect the war resolution to happen at some point this quarter. And if that's your assumption, I think central banks around the world are likely to stay on hold for the rest of the year.
Well, Amol Shitole, thank you so much for your time as the head of fixed income as Mashreq Capital this morning, taking us through the various consequences of what we've been seeing in the escalation, particularly in the last few days in the Red Sea. Well, the White House Office of Science and Technology accuses China's Moonshot of violating U.S. export controls in the creation of its Kimi K3 system. We'll get the details on that story next, and this is Bloomberg. Well, a White House official is accusing China's Moonshot of improperly using American AI models and Nvidia chips to create its Kimi K3 system. It's the latest U.S. claim of a possible IP theft by Chinese AI platforms. For more, let's bring in Bloomberg managing editor Jill Deesis. So, Jill, give us the sort of details of the latest sort of twist in this sort of saga with the sort of Chinese AI firms, the details and, of course, the context.
Sure, Oliver. So, look, what this accusation revolves around is this idea that this U.S. official is accusing this company of basically using these GB300 chips sourced from Thailand. So these are Nvidia's more advanced chips from its Blackwell line, and this is largely, these are really cutting-edge chips that are ultimately banned from being exported to China. Chinese firms do have access to some sort of lower tech chips from Nvidia's line, but not these more advanced chips. So that's essentially what this accusation is revolving around, is this idea that Moonshot used cutting-edge chips that weren't supposed to be available to Chinese companies in order to develop its latest AI models, which I will point out that Kimi K3 model, when it came out, really shocked the tech industry there. What Moonshot is kind of claiming here is that these are, AI models that are competitive with all of the other, big ones, maybe outside of the most advanced Anthropic Claude, Fable 5 model, as well as the latest ChatGPT model. So, I mean, some really serious stuff. You have to point out that NVIDIA and Moonshot so far have not responded to requests for comment.
Yeah, well, really quickly on this, Jill. I mean, how can the United States really expect this to be completely watertight? And the other real question is there going to be any consequence for this, given the sort of strange relationship we have between Donald Trump and China, one time very hawkish and sometimes very dovish?
Right. I mean, obviously, there's been these ongoing allegations against Chinese companies for years at this point about whether or not they've circumvented various export restrictions and all other kinds of controls in order to gain access to advanced tech. Comes to mind some Huawei smartphone developments from just a couple of years ago, where some of these similar concerns came up. I mean, you may have an indication where maybe there's attempts to close the loopholes, but again, there's kind of this push and pull. And I think when it comes to as you mentioned, some strangeness within the U.S.-China relationship, we also have to look forward to that sort of personal relationship between Donald Trump and Xi Jinping. These two world leaders are supposed to be meeting in just a couple of months' time from now. So some indication there that is that going to continue to go forward? I think we'll have to see how that factors into the equation here for the U.S.
Always watching that relationship very closely for us. Jill Deesis, our managing editor there. Thank you very much. Well, coming up, we're trying to reckon with the possibility of a second front in the war with Iran. We'll do that with some of our reporters on shipping and the consequence that it'll have, of course, on the oil market. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. A widening war. The Houthis attacked 2 Saudi tankers in the Red Sea as the U.S. conducts further strikes on Iran. Oil rising as the market reckons with the possibility of a second front in the Middle East. And the nuclear path. The U.S. signs an agreement with Saudi Arabia to share nuclear technology, opening the door for the country to enrich its own reactor fuel. And burning cash. Alphabet shares fall after another boost to its spending forecast. Meanwhile, Elon Musk warns of a massive capex year at Tesla as the AI race heats up. It has just gone 8:30 a.m. across the Emirates, 6 a.m. here in Brussels. I'm Oliver Crook. Let's get across your markets this morning. The focus, of course, this morning on Brent crude oil trading higher this morning by about 2%. You can see that breaking through $95 a barrel, just flirting with that $96 a barrel level, up about $2, 187 this morning. Euro dollar also in full focus this morning, up 0.1%, up at 114. That is ahead of the European Central Bank rate decision that we are expecting out of Frankfurt a little bit later today. We will probably not get a hike. We will probably get no action, but we will, of course, get some guidance from the president of the European Central Bank, Christine Lagarde, and her view of inflation across Europe. Of course, MSCI Asia Pacific Index trading up by 1% this morning after those reports of big capex spends from those companies in the United States, benefiting some of those companies across Asia. And of course, the other side of that trade, you see the NASDAQ was down a bit more earlier. It's trading basically flat this morning, down by about 30 points. Let's get under the hood. Let's get into the real market action over in Hong Kong with Winnie Su. Winnie, what are we seeing this morning?
Yeah, good morning, Ollie. We are seeing Asian stocks extending gains for a third day now. This is the longest of such streak we've seen in a month. Still, the support is mainly coming from the technology shares, as you just mentioned. Hence, we are seeing South Korea's Kospi index here up by about 4%, with foreign investors buying for a fourth session so far this week. So every day we are seeing buying from foreign investors after them having, in fact, sold for the past 4 weeks. Now, that flooring inflow is really helping the South Korean won here to outperform all the other Asian peers. Here, strengthening by 0.7% to the highest, to the strongest level against the dollar in about 10 months. Now, this strength in the Korean won also being supported by the better than expected GDP numbers that also raised the bets around the rate hike to come. Now, when it comes to Japanese yen, still hovering around that 163 level against the dollar, which is the weakest in about 4 decades. Now, flip the board, we take a closer look at the technology shares because, yes, we have that news from Alphabet raising their capex estimates for this year to top $200 billion, and that is likely going to benefit the supply chain here in Asia. In fact, you are seeing SK Hynix here up about 5%, and the company is getting about 7% of its revenue from Alphabet. And also, we are seeing Japanese suppliers, Advantest and also LaserTech, also rising because we do have lots of these equipment makers of chip making here in Japan. So we are seeing across the supply chain shares in Asia rising. Back to you, Ollie.
Thanks very much, Winnie Su, over in Hong Kong with the market action over in Asia. Now let's bring it back to the oil market, where prices have hit their highest level in over a month after the Iran-backed Houthi militant group said it attacked 2 Saudi Arabian tankers in the Red Sea. The attack has escalated the Middle East conflict beyond the Strait of Hormuz and now threatens a deeper energy supply chain disruption. Joining us now is oil and shipping reporter Wei Lun Soon. So listen, we've been very focused on the Strait of Hormuz. The Red Sea and the sort of passage over there has really fallen to the back burner over the last sort of year or two. What is the significance now of this possible disruption from the Houthis? And do we have a clear idea of what Houthi capacity is and how much they can actually constrict motion?
Right. Thanks, Oliver. If we talk about the Red Sea, we need to talk about the port Yanbu in Saudi Arabia on the Red Sea, which has been really crucial during the role that it plays during the Iran war, because Saudi Arabia was able to divert a lot of the flows from the Persian Gulf to avoid the Strait of Hormuz and pump it out through Yanbu, where vessels will pick it up and go to Asia. So about last week, we analyzed that around 6 million barrels per day was shipped out from Yanbu. This has continued a little bit, but with the recent attacks that was just seen overnight, there's a potential that ships might not want to go into the Red Sea anymore. And this would put about 4 to 5 million barrels per day of those flows at risk. So we would need to see how ships will want to move out of the Red Sea. There are 2 ways for them to go out. One is via the southern route, which is the Bab el-Mandeb. But that is where the Houthis apparently have dug in positions with missiles, with drone strikes to attack ships that go through the choke point. And then towards the north, you have the Suez Canal, where if they were to pick up the Yanbu cargoes to go to Asia, they will incur a lot of cost and a lot of delays to those deliveries for ships going through the Suez Canal.
So we have an idea of what the sort of trading range possibilities are for the Strait of Hormuz, the effect that it has on the oil market, you know, breaking up just above $100 a barrel. Do we have any idea of the sort of pricing that this kind of disruption would have on the oil market from the Red Sea side of things?
So the Wall Street Bank, Goldman Sachs, has just issued out a note saying that they don't see a lot of near-term disruption to prices. That's because any constricting, any lower supplies from the Middle East is actually offset by weaker demand from Asia. But no doubt with a further upside with the 2 choke points, that means the Bab el-Mandeb and also the Hormuz situation getting worse. We see traffic, shipping traffic actually going down. This will further knock on into like future oil prices, and we can see it hitting higher, maybe towards $100 per barrel.
Well, that's something that we're watching very closely, but I'd like to guess our minds a little bit into the future because, of course, now, particularly in Europe, it is the summer season, so there's going to be slightly less demand, certainly for gas, for oil. If we see this as sort of sustained disruption, what's going to happen within the oil market? Are we going to see a sort of bifurcation for pricing? Because as you were pointing out, that oil that's coming from Saudi Arabia can probably still make its way up to Europe, but potentially not to Asia. What are we going to see within the oil market?
We're going to see a lot of scrambling for buyers on the front on trying to pick up barrels from elsewhere around the world. We do see scenario planning for ships, especially for Asian buyers, which is where I sit in. A lot of them will think of how to reroute ships, pick up barrels from the Atlantic basin instead of going through the Middle East, because the cost and benefit analysis in terms of freight, in terms of delivery times, it's now much narrower. And those are safer routes for Asian buyers to pick up. So you would see definitely some shifts in buying patterns.
Well, Bloomberg's Wei Lun soon for the latest there. We're seeing the disruption over the Red Sea and the effect that it is having on the oil market this morning. Now, Canada's foreign minister has told us Prime Minister Mark Carney has spoken to U.S. President Donald Trump and agreed to intensify talks relating to trade. Anita, Anand spoke to us on the sidelines of the ASEAN meeting in Manila and began by discussing the markets of top importance to Canada as it looks to diversify away from the United States.
We are doubling non-U.S. trade over the next 10 years, but we also want to make sure that we have a very stable and distinct sovereign approach to our economic future, and that means diversifying trade.
I suppose this is partly to shield from the impact of U.S. tariffs as well. And speaking of that, there is an additional 50% tariffs from the U.S. hitting Canadian goods in 30 days' time. During this 30-day period, is Canada willing to look at offering concessions to the U.S. in exchange for lower tariffs?
So let's just remember that Canada and the United States have been close trading partners for decades and decades. We are bound together by geography. The Prime Minister spoke with the President yesterday, and they agreed to intensify talks relating to trade, and that will be undertaken by our Minister for Canada-U.S. Trade and our Chief Trade Negotiator. At the same time, we have to remember we can do multiple things at the same time, and therefore pursuing this diversified trade agenda, making sure that we have these free trade agreements with other countries, such as the Philippines. We're negotiating a comprehensive economic partnership agreement with India right now. We signed a free trade agreement with Indonesia in late 2025. Those are just examples of the way we'll diversify while those trade talks with the United States are ongoing. Right now, we are the only G7 country that has a free trade agreement with every other G7 country. That's the foundation of our trade diversification policy. But we are going a step further with those over 20 agreements in security, defense, and economic matters, with free trade negotiations that are occurring now.
One of the big concerns here is the inflation that is brought about by the Iran war. And I wonder, as an energy exporter, as Canada is an energy exporter, is your energy sales to Asia increasing after the Iran war?
It's a good point to highlight Canada's competitive advantage in the area of energy. Whether it's LNG from our west coast, whether it is clean or conventional, whether it is nuclear or solar or wind power, Canada is a leader. We will be the only G7 country working on the SMR technology, for example, out of Darlington, Ontario. All of that to say that energy figures quite prominently in both our bilateral and our multilateral conversations. And around the table this morning, I heard significant interest from ASEAN countries about ensuring that there's energy cooperation and climate change.
The thoughts there from Canadian Foreign Minister Anita Anand speaking to Bloomberg's Min Min Lo over in Manila. Well, coming up, Emirates telco DO reporting steady second quarter performance and growth. We'll get a little bit more detail with the CFO in a conversation that will be taking place just after the break. We'll go through their numbers and, of course, the outlook for the Emirates. That's the conversation we'll be having next, and this is Bloomberg. Welcome back to Bloomberg Horizons Middle East and Africa. Emirates Integrated Telecommunications Company, also known as DO, have reported a steady first half performance for 2026 and their latest second quarter earnings report. The telecom service provider saw revenue growth of 4.6% for the quarter and net profits up 12.6% for the first half of the year. And we're very pleased to be joined by the Chief Financial Officer, Ben Hamida of DO. Thank you so much for joining us this morning. So listen, I'm sure it's been a very complicated couple of months for anybody running any business in the Emirates. Give us an overview of what we saw here in the second quarter.
Good morning, Oliver. DO has an excellent set of numbers, as you have highlighted in the first half of 2026, despite a quite complicated, volatile macro environment and regional environment. Revenues at 8.2 billion, 5.8% growth year-over-year. EBITDA at 4 billion, 10.5% growth year-over-year, and net income at 1.6 billion, 12.6% year-over-year. The board approved an interim dividend of 26 fils, which is a growth of 8.3% compared to the interim dividend of last year. So this shows how defensive is the industry, how is effective our operating model that allowed us to show this set of numbers in the environment that we were talking about.
Yeah, and so as you mentioned, the environment there, a challenging environment, which you make a reference to a couple times. In your earnings report, you also make reference to the fact that growth and moderation from prior periods has been moderating in terms of the growth rate. Still a growth rate, but one that has moderated. Giving access, as you do, to the sort of information about people that are coming, potentially getting SIM cards, what do your numbers in the last quarter tell us about the volume of people coming into the Emirates, specifically on tourism?
Yes, definitely. I mean, we've seen, as you've seen in the number, our base, our prepaid base in particularly, we saw a moderation of the growth that is fundamentally driven by the reduction of the tourism activity in the country. However, on the other side, our postpaid base held strong with a 9% growth year-over-year, and our fixed base also has been growing at 5.5% year-over-year, and this sustained an excellent level of revenue growth in the fixed at 11.6% and also in the prepaid base. So we see a little bit of disconnection. On one side, the long-term contract, the ones that are taken by the resident, are holding up, while we're seeing a moderation, as I highlighted in the part that is affected by the tourist activity.
And the word of the day seems to be CapEx. That's what we heard from Alphabet earnings, spending a lot of money. The same with Tesla, and of course, building out all that AI infrastructure and data centers is absolutely paramount, not just for them, but of course also for you. How does this sort of conflict, does it change anything in terms of your outlook, in terms of spending on the projects that you're focusing on, and particularly on the data centers?
Look, the short answer is no. We've been maintaining our CapEx plans, both when we talk about CapEx related to our network and also into what we call beyond the core, which is fundamentally the data center. So we've been driving as per our plan, and we even accelerated the deployment in the data center to cope with certain commitment that we have vis-a-vis of our partners to deliver certain blocks of data center capacity at the end of the year. What we're doing, however, is we're monitoring carefully the evolution of the situation, and we will adapt when it comes to the deployment. But we believe that as of today, we're deploying as per plan. I think also the strong balance sheet of DO is an important factor that is allowing us to maintain all our plans, while at the same time serving to our shareholders a very healthy and generous return.
And we're speaking this morning as we see the possibility of a further escalation in the war, this time on the side of the Red Sea. We've heard from the Houthis in the past talking about potentially cutting undersea cables that carry fiber optics. Is that something that you, as sort of on your risk radar, how do you insulate from that kind of risk? What kind of effect would that have?
I mean, as you can imagine, for an infrastructure that is as important as the telecom that we're operating, we do have several alternatives and several recovery systems that will allow us to operate and redirect the traffic to cope with the various situations, including the one that you're talking about.
Well, Kais Ben Hamida, thank you so much. That is the Chief Financial Officer this morning of DO, bringing us that perspective on obviously the broader region, but of course on the morning of their earnings report. Well, coming up next, we will go to Frankfurt ahead of that all-important ECB interest rate decision. Not expecting a move, but we are expecting some guidance from the President of the ECB, which will be very closely watched by the markets. That's next, and this is Bloomberg. Welcome back to Horizons Middle East and Africa. Expectations have hardened for South Africa's Reserve Bank to raise interest rates after annual inflation rose in June. Consumer prices increased 5% compared with 4.4% back in the month of May and exceeding the medium forecast for 4.7%. A survey of Bloomberg economists see the central bank raising rates by 25 basis points to 7.25% when it meets a little bit later today. Now, the other central bank that is in full focus is the European Central Bank, where they will meet and expected to keep rates unchanged this time. The deceleration of euro area inflation in June set to eliminate the need for urgent action until September, when borrowing costs could yet again be raised. For analysis on all of this, we're joined now by Bloomberg's Jana Randau, who is at the ECB headquarters for us this morning. So, Jana, what are we expecting to hear from today's meeting? Is this a sort of an opportunity for the ECB to buy its time in order to see what happens in the next couple months?
Yes, for sure. Good morning, Oliver. So no change, you said it. Really nobody expects it, not economists, not traders. It's a meeting where words matter more than action. So it's all about what the president has to say about how the economy has done so far from the June meeting, and more importantly, maybe even how the risk balance has changed, how risks to the economy, to the growth outlook, but also, most importantly, of course, for inflation have developed with this new escalation in the Middle East. Now, there was a moment, of course, after the ECB's June meeting when they raised rates for the first time since 2023, where things really looked good. A ceasefire in place, oil prices down, the economy closer to the milder scenario the ECB lined out that had inflation come back to the target sooner. But of course, the escalation that we've seen also again overnight, that means it's back to square one, as one of the governors recently said. So more monitoring the situation, collecting data, waiting for very important projections in September, and decide then whether more hikes are needed.
Yeah, and the escalation of the war obviously is not a good thing for anybody, certainly for the European economy and for the ECB. But it sort of validates, I think, probably what happened in the last decision, when there was potentially some doubt about that if you did have a resolution. Casting our mind forward over to the September meeting, what are we watching there? What are we watching in terms of the potential spillover effects, secondary effects, and of course the concern for growth?
Yeah, I mean, September, that's when a lot more information, a lot more data will be available. 2 more inflation reports, GDP figures for the second quarter, and most importantly, projections. Now, the ones in June, they had inflation back at 2% around 2028, so the end of the forecast horizon. In the medium term, so broadly, the timeline the ECB looks at when it defines price stability, That may change, and that would be the clearest indication. Now, the other thing that we're watching and policymakers are watching very carefully is how those energy prices, oil prices, gas prices that are very, very elevated, how they filter through to the economy. We've seen indirect effects. So if you think fuel prices, if you think, transport, airline tickets, these kind of things where energy really fits in. We've seen those, of course, react. Second round effects, the one that policymakers tend to be very allergic to, wage growth, for example, is in that category. We haven't seen that, but those are lagging indicators. They take a bit of time to filter through.
Yeah.
So any sign, in that category, that would be alarm bells ringing at the ECB, and that would essentially really push them into that direction of a hike.
Well, thanks very much to Bloomberg's Jana Randau there. As you can see outside of the ECB headquarters over in Frankfurt, watching very closely that press conference that we'll be getting from the president of the European Central Bank a little bit later today, with a keen focus on the inflation picture across the world and what we're expecting in the months to come. That's it for Horizons Middle East and Africa. Stay with us. Bloomberg Daybreak Europe is next. That'll be next. And this is Bloomberg.